Welcome to vTalkInsight, Market Drivers Daily for December 12, 2025. AI volatility is colliding with a surprisingly resilient growth backdrop and a noisy geopolitical tape, leaving investors to decide whether this is healthy rotation or the start of a regime shift. Let us begin with how the AI trade is evolving after a pivotal earnings shock. The dominant story for markets right now is no longer the latest central bank move, but how the AI cycle is playing out in real cash flows and balance sheets. Recent days have reinforced that theme, as investors juggle a still supportive, late-cycle backdrop with far greater scrutiny of who is truly earning a return on massive AI spending. That tension is clearest in the reaction to Oracle's latest results, which have become a test case for how much pain markets will tolerate in pursuit of long-term AI upside. Oracle's earnings miss and sharply higher AI capital expenditure have delivered a meaningful shock to sentiment across AI equities. The company guided to a roughly 40% increase in capex, lifting total AI-related spending to around $50 billion and pushing its capex to revenue ratio to about 75%, far above its long-run average. That comes alongside a reported $10 billion quarterly cash burn and more than $100 billion of debt, raising pointed questions about how quickly these investments can translate into revenue and margins. The result was a drop of roughly 11% in the share price and pressure on Nasdaq futures, with weakness spilling into other AI-exposed names in the United States and Europe. Under the surface, investors are focused less on one quarter's earnings and more on concentration and funding risk. Oracle's backlog now exceeds $530 billion, with over $300 billion reportedly tied to OpenAI, leaving future revenues heavily dependent on a small set of clients and on the durability of those contracts. At the same time, shrinking software revenues, heavy infrastructure spend, and elevated leverage have pushed the cost of credit protection higher, turning Oracle's derivatives into a useful barometer of AI-related credit risk. This matters because private credit funds already have roughly 41% of their exposure in technology, so any sustained stress around AI borrowers could quickly migrate into less liquid parts of the capital structure. The broader question is whether the AI complex is sliding into bubble territory or simply digesting an aggressive but rational capex upswing. On one side, some investors argue that current AI infrastructure spending still looks proportionate to cash flows and gross domestic product, with no hard evidence yet of a classic bubble despite stretch valuations. On the other, several analyses suggest that AI equity prices now embed revenue and profit paths that may be unrealistic, in some cases implying future cash flows larger than entire existing revenue pools. That debate is happening against forecasts that AI-related capex could rise from around $450 billion this year to several trillion by the end of the decade, and that the Nasdaq could still climb more than 10% next year on AI momentum. Balancing those valuation concerns is a powerful productivity and growth narrative that policymakers are increasingly embracing. The Federal Reserve has raised its projection for next year's real growth to about 2.3% and marked inflation lower, explicitly citing AI-driven data center investment and stronger productivity as key supports. Estimates suggest AI could lift United States productivity growth by roughly 0.5 percentage point over the next 5 years, allowing the economy to expand around 2% without increasing total hours worked. Enterprise adoption is already visible, with Fortune 500 firms across finance, healthcare, and energy reporting tangible productivity improvements, while hyperscalers such as Broadcom guide to doubling AI semiconductor revenue to more than $8 billion and nearly $19 billion of overall quarterly revenue. At the ecosystem level, AI is spreading far beyond chips into content and life sciences. Disney's $1 billion equity investment and licensing deal with OpenAI opens its catalog of around 200 characters for AI-generated short-form video, signaling that major studios now see AI as a high-margin way to monetize intellectual property. In biotechnology, AI-designed drugs are moving rapidly through clinical trials, with one antibody for respiratory disease already in late-stage testing, while the United Kingdom and China are emerging as important hubs for pharmaceutical AI alongside the United States. These real-world deployments support the argument that AI is still in the early phase of a multi-year adoption curve, even if equity pricing may be ahead of fundamentals in some names. However, adoption and returns remain uneven, which tempers some of the exuberant forecasts. Surveys of around 4,000 companies show that AI rollout is slower than many headlines imply, with modeling suggesting only about a 20% probability that the economy has already shifted into a higher productivity regime. There's an active debate about whether simply scaling large language models will keep delivering big performance gains, and OpenAI's latest releases are seen as incremental improvements rather than game changers. At the same time, voices such as Howard Marks warn that AI-driven labor disruption could mean significant job losses and difficult social adjustments, raising questions about how broad-based the benefits of the AI boom will ultimately be. These cross-currents are now feeding directly into macro and currency narratives. AI capex is largely being funded by companies whose spending plans are relatively insensitive to interest rates, which suggests traditional monetary policy may have less influence over the cycle than in past expansions. Some market views now argue that Federal Reserve policy is a secondary driver for equities unless it shifts in a very aggressive easing or tightening, with AI sector dynamics doing more of the heavy lifting for risk assets. Importantly, several scenarios highlight that a sharp correction in AI equities could itself trigger steeper rate cuts and a flight to safety, supporting core currencies such as the euro, Swiss franc, and yen, while leaving higher beta currencies like the Australian, New Zealand, and Canadian dollars at risk of underperformance. Looking ahead, markets are searching for clear evidence that AI spending is turning into durable earnings growth. Expectations are that more convincing proof of AI-driven productivity and monetization could emerge over the next 9 to 12 months, making upcoming corporate guidance crucial. Within that window, Oracle's financing decisions and clarity on OpenAI commitments, Broadcom's ability to sustain its AI revenue run rate, NVIDIA's next chip launches, and the ramp-up of partnerships such as Disney OpenAI will be important markers. Regulatory initiatives, including the Treasury's new working group on AI in the financial system, add another layer as authorities try to harness innovation while watching for systemic risks. All of these developments in AI feed directly into the broader growth story, where macro data and policy are still painting a surprisingly resilient picture. The growth backdrop continues to look sturdier than many expected, even as markets acknowledge that the cycle is fairly mature. The Federal Reserve has upgraded its forecast for next year's real United States growth to around 2.3%, while still signaling rate cuts, and some private forecasts now contemplate growth exceeding 4% if AI infrastructure, manufacturing reshoring, and investment inflows all deliver. That combination of firmer growth and easier policy is one reason risk assets have stayed supported despite recent volatility in AI-heavy indices. Hard data on consumers and trade are broadly consistent with that constructive view. Holiday sales are expected to grow at a mid-3% pace, with Black Friday spending up just over 4% from last year, and foot traffic at major malls such as Mall of America and Tysons Corner reportedly rising between 8 and 11%. Retailers that blend strong in-store experiences with seamless digital channels are outperforming pure online players, while companies like Costco are reporting more than 20% growth in digitally enabled sales and double-digit gains in membership fees. At the macro level, the United States trade deficit has narrowed sharply to just over $52 billion, the smallest since mid-2020, driven by faster growth in exports than imports and hinting at improving external demand. Policy and liquidity are adding to those private sector supports. Recent Federal Reserve cuts and more dovish communication have shifted policy away from being clearly restrictive, while markets still price further easing alongside elevated long-term yields. On the fiscal side, an annual stimulus on the order of $150 billion starting in January, together with tax changes that boost paychecks and refunds, is expected to create a positive sentiment shock for middle-income consumers. Proposals to prioritize high-skill, capital-rich immigration could further support long-run growth by attracting talent and investment, especially when combined with corporate confidence that is visible in robust merger and acquisition activity. Growth is also broadening geographically and sectorally. Foreign banks, such as J.P. Morgan, are expanding operations in India, citing strong credit appetite and deepening corporate activity, while economies like Portugal are delivering growth above 2% on the back of structural reforms to taxes, labor laws, and bureaucracy. Within the United Kingdom, Greater Manchester is growing roughly 3 times as fast as London, highlighting the impact of regional devolution. And Canary Wharf is diversifying beyond finance into life sciences and technology with what is set to be Europe's largest lab complex. In travel, airlines report particularly strong demand for premium cabins, with lie-flat seating expected to rise by about 50% and overall premium capacity by 20% in coming years, while domestic tourism and hospitality metrics in cities such as New York remain robust. Another dimension of the growth narrative is the rapid expansion of digital assets and retail participation in capital markets. Tokenized real-world assets are projected to grow from roughly $35 billion to more than $500 billion in value locked by next year, helped by regulatory clarity and institutional blockchain initiatives. Stablecoin supply is expected to approach $1 trillion by 2026, and crypto exchange-traded products are forecast to outgrow even large technology benchmarks amid rising demand for diversified digital exposure. Retail investors are also allocating capital at nearly twice the 5-year average, with inflows more than 50% above last year, underscoring how households are leaning into markets at this stage of the cycle. There are, however, important caveats to the optimistic growth story. Company surveys indicate that AI adoption and productivity gains are progressing more slowly than the most bullish scenarios assume, with only about a 1 in 5 chance that the economy has already shifted into a higher productivity regime. Concerns are building that AI-driven automation could compress labor demand, and that productivity improvements may not translate into broad job creation, complicating the picture for wage growth and consumption over time. On the macro side, long-dated government bond yields remain elevated in real terms despite rate cuts, reflecting persistent worries about fiscal deficits and heavy issuance. While some managers are rotating equity exposure away from the United States toward cheaper international markets with stronger expected growth into 2026. Going forward, investors are likely to focus on 3 clusters of growth signals. First, incoming productivity data and corporate earnings guidance will help validate or challenge the thesis that AI can add roughly 0.5 percentage point to productivity and sustain above-trend growth without reigniting inflation. Second, high-frequency consumer indicators, from holiday sales to travel bookings and mall traffic, will show whether fiscal support and easier policy are feeding through to actual spending or simply offsetting higher borrowing costs. Third, policy decisions on immigration, fiscal packages, and regulation of digital assets will shape how durable these growth tailwinds prove to be. All of this sits against a backdrop of elevated geopolitical noise, which is affecting some markets far more than others. On the geopolitical front, the clearest recent flashpoint is the United States' seizure of a sanctioned Venezuelan oil tanker. The move marks a significant escalation in enforcement against Caracas and has been accompanied by a higher military profile in the Caribbean, raising questions about how far Washington will go in policing sanctioned crude flows. Despite that, the immediate impact on oil has been limited. Prices saw only a brief spike, and benchmarks remain subdued, reflecting both ample global supply and the fact that Venezuela accounts for less than 1% of world output. Paradoxically, if relations between the two countries improve and sanctions are eased, A subsequent increase in Venezuelan exports could add to medium-term downward pressure on prices. Energy markets are also digesting signals from producers and other regional tensions. OPEC Plus has recently indicated that supply and demand are roughly in balance, suggesting limited appetite for additional output cuts even as new disruptions emerge. At the same time, repeated references to tanker seizures and sanctions enforcement keep a persistent risk premium in play, even if oversupply concerns are currently dominating price action. The important takeaway for investors is that spot prices can look calm, while the distribution of future outcomes for energy remains unusually wide. In Europe, the geopolitical focus is on how to finance Ukraine's war effort and reconstruction. Finance ministers are debating whether to deploy around 90 billion euros of frozen Russian assets, a sum that could cover roughly two-thirds of Ukraine's budget and military needs over the next 2 years. Annual support under discussion is on the order of 100 billion euros, only about 0.5% of European Union gross domestic product, but agreement has been elusive and failure to act is seen as a risk to both European security and political cohesion. Alongside this, Kyiv has submitted a revised peace proposal and is negotiating a reconstruction framework and security guarantees, while drone strikes on Russian fertilizer plants have already driven sharp moves in related commodity equities. Beyond energy and Eastern Europe, trade and technology frictions remain a structural source of uncertainty. Mexico has approved new tariffs of between 5% and 50% on more than 1,400 Asian imports, aligning closely with United States efforts to curb Chinese exports and raising the risk of retaliatory measures from Beijing. United States policy on advanced chips follows a similar logic, with a strategic arrangement involving NVIDIA designed to keep Chinese developers reliant on American technology stacks, even as some exports are allowed. Regulatory tensions around Chinese e-commerce platforms, including reports of clashes between company staff and officials, underline that idiosyncratic policy risk in China's tech sector remains elevated. For markets, the unifying feature of these geopolitical stories is selective pricing. Oil and broad equity indices have largely treated the Venezuela episode as a local issue, whereas fertilizer producers, specific energy names, and companies directly exposed to tariffs or sanctions have seen more pronounced moves. Looking ahead, key watch points include any further United States actions against Venezuelan crude exports, concrete European decisions on using Russian assets for Ukraine, the evolution of Mexican tariffs and China's response, and the tempo of Ukrainian strikes on Russian infrastructure. In a market already characterized by late-cycle dynamics and heavy reliance on AI and policy support, a shift in any of these geopolitical fronts could quickly alter risk premia across energy, commodities, and select equity and credit sectors. Across today's stories, one message stands out. Markets are still leaning on an AI-driven, policy-supported growth narrative, but the room for error is shrinking. AI-heavy names face tougher questions on capital efficiency and concentration risk, even as productivity hopes remain central to optimistic earnings paths. Growth data and fiscal plans continue to point to a resilient, late-cycle expansion, while geopolitics is generating sharp, localized moves in energy, fertilizers, and trade-exposed sectors rather than a broad risk-off turn so far. Watching how AI monetization, consumer resilience, and geopolitical decisions evolve over the next few quarters will be critical for understanding whether today's volatility is consolidation within a bull market or the start of something more structural. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.